Hi, I'm Jessica Rabe, one of the co-founders of Data Trek Research. To start today's video, I'm going to ask you to consider this question. Would you rather have Warren Buffett manage your money or just invest in an index of US large cap technology companies? The reason I ask is because other than his well-publicized position in Apple, which he's been selling this year, Berkshire Hathaway tends to buy older line businesses. Now, I want to make clear that we have a lot of respect for Warren Buffett. He is one of, if not the best money managers of all time. That said, US large cap tech's long run performance tells a clear story about the power of disruptive innovation. Check out this table with the price return data for BRK, the symbol for Berkshire Hathaway, XLK, the symbol for the S&P 500 Tech ETF, and the Qs, the symbol for the Nasdaq 100 ETF. This may surprise you, but whether you're looking at 5, 10, 15, or 20-year price returns, large cap US tech or the Nasdaq 100 have always outperformed Berkshire Hathaway and by a wide margin. As you scan through these price returns, I'm going to briefly put them into perspective. So if you had invested $10,000 in US large cap tech or the Nasdaq 100 20 years ago, you would have $111,400 or $130,300 today, respectively, even without adding in the impact of dividend reinvestment. The same $10,000 in Berkshire would have yielded just $86,900, 22 to 33% less than the investment in XLK or the Qs. And unlike those two ETFs, BRK does not pay a dividend. Now, there are some periods where Berkshire has outperformed the US large cap tech sector or Nasdaq 100. This chart shows the relative one-year trailing return between BRK and XLK, noted by the blue line, and BRK and the Qs in the orange line back to 2010. When the lines are above the x-axis, Berkshire beat the S&P 500 tech sector and Nasdaq 100 by the number of percentage points noted on the y-axis. When the lines are below the x-axis, XLK and the Qs have outperformed BRK over the prior year. I have 4 points on this chart. The first is that since 2010, US large cap tech and the Nasdaq 100 have, on average, outperformed Berkshire by 4.3 and 5 percentage points on a price basis, respectively, over any given 252 trading day holding period, which is one calendar year. Some of this is due to tech's strong relative outperformance in 2011 during the Greek debt crisis and in 2020 during the pandemic crisis, but tech also reliably beat BRK in the mid to late 2010s. Second, the win rate or positive relative annual returns for XLK and the Qs versus BRK is 64 to 66%. Put another way, the two tech indices have beaten Berkshire over any given year-long period 2/3 of the time since 2010. Third, Berkshire tends to outperform tech either during a rebound in financials and value stocks like in 2010, 2013, and 2021, or when rates are rising quickly and hurting high valuation names like in 2022. And fourth, BRK's one-year rolling returns have outperformed XLK and the Qs since mid-November. Over the last year, BRK has beaten XLK and the Qs by 8.2 and 3.9 percentage points, respectively, above the long-run average, but still within one standard deviation and therefore normal. Keep in mind that the one-year comp was in late November 2023 when XLK and the Qs were outperforming BRK by over one standard deviation, which is statistically significant, so there is some reversion to the mean here. To wrap up, I have 3 takeaways on this data. Our first takeaway is that tech-based index funds like XLK and the Qs outperform legendary investor Warren Buffett over long-term holding periods because they leverage disruptive technology rather than rely on exposure to more traditional industries. The companies in XLK and the Qs employ tens of tens of thousands of talented engineers and tech-savvy business leaders with the common goal of creating and leveraging the next big thing. For example, enthusiasm around generative artificial intelligence has enabled XLK and the Qs to mostly outperform Berkshire since early 2023, given their large exposure to NVIDIA. Big tech is responsible for more than half the S&P 500's 26.5% year-to-date return, and NVIDIA alone is worth a third of the index's year-to-date return. We don't see any reason why disruptive innovation won't continue to drive U.S. stock market performance over the next decade, just like it has for the last 20 years. We've been consistently bullish on U.S. large-cap tech companies over the long term since we started DataTrek research over 7 years ago. We have not wavered from that view, which has worked very well, and we believe it will continue to do so. Our second takeaway is that we're not suggesting Berkshire shareholders give up on BRK in favor of tech-heavy indices. However, we'd certainly consider adding U.S. large-cap tech or the Nasdaq 100 to portfolios that already have exposure to BRK. Both investing approaches serve different purposes, but the longer-run outperformance of tech is crystal clear. Disruptive tech is a secular investment theme that consistently beats the investment approach of one of the most talented money managers ever. This comparison highlights why we have an entire section dedicated to disruptive innovation in our daily markets newsletter, the DataTrek Morning Briefing. Any investment approach that can beat Warren Buffett certainly deserves that attention. Lastly, you've probably seen that Warren Buffett has been selling stocks over the last few months, and Berkshire did not buy back even any of its own stock last quarter. Some people think that's because Buffett sees a top in the stock market. Our own view is that he is more likely preparing to hand off management of the company to his successors and wants to give them free rein to make their own investment and capital allocation decisions. With that, thank you very much for taking the time to watch this video. Please hit the like and subscribe buttons if you enjoyed it. And you can check out our website, datatrekresearch.com, for a 2-week free trial to our daily reports on markets, data, and disruption. There's no credit card or personal information required. You just have to drop your email in. Thank you again for watching, and we hope you have a great day.